Hello, Ziegfried here from Cloud-Based Services Accountants. Today I want to talk about tax treatment of crypto assets received from blockchain forks and airdrops. Now, to some of you, that might sound like foreign terminology, but I'll explain what it means. So in December 2020, Inland Revenue released an issues paper on whether receipt and subsequent disposal of crypto assets received from a blockchain hard fork or an airdrop are taxable. So just to explain the terminology, so a blockchain is a type of distributed ledger technology providing a digital record of transactions that is shared and maintained by users across a network. So it's a very secure technology, and as I've mentioned, it is a distributed ledger, and it is maintained by all the users across the network. And blockchain can be applied to much more than only crypto assets, but that's a discussion, another discussion. A hard fork, or sometimes it's also referred to as a chain split, changes the protocol code to create a new version of the blockchain alongside the old version. So it's quite logical. So if you've got the existing blockchain, it will split into another protocol, and that's called a hard fork. And thus creating a new token that operates under the rules of the amended protocol, while the original token, so the original chain is still carrying on, and the new chain, the split chain, will carry on its own. Airdrops are distributions of crypto assets for no payment. So it's almost like a gift, and generally undertaken with a view to increase awareness of a new token, so a promotional gift, particularly amongst influencers, and to increase liquidity in the early stages of a new token project. So it's a marketing strategy where they airdrop or where they give it out for free. So there are possible income tax consequences to consider. So firstly, there are no special tax rules that apply to crypto assets. So general principles apply. In many cases, a receipt of new crypto assets from hard fork, that's split, or airdrop for free will not be income to the recipient. So instances where the receipt of new crypto assets may be income include where the recipient has a crypto asset business, such as dealing or mining business in crypto assets or currencies, or the recipient is involved in a profit-making undertaking or scheme involving acquisitions of airdropped or forked crypto assets. So that person is focusing on getting his hands on those promotional gifts and then selling it off again. Or the recipient has received airdrop crypto assets as payment for services provided. So yeah, that's obvious, that's payment. And receives airdropped crypto assets on a regular basis, such as that the receipts have the hallmarks of income. So whether amounts received from disposing of these crypto assets are taxable depends on the person's circumstances. So to summarize, crypto assets that are received from a hard fork or an airdrop by a crypto asset business, as mentioned, somebody that's dealing in or crypto assets or mining, are likely to be trading stock of the business and subject to trading stock rules. And disposable of trading stock are taxable as business income. It is possible that Section CB3 of the Income Tax Act, where it describes carrying on a profit-making undertaking or scheme, may apply if the person has a relevant profit-making undertaking or scheme. For disposals of crypto assets that were received as a result of a hard fork, competing analysis can apply to determine the correct tax treatment. The more compelling argument is the person's purpose for acquiring the assets, the crypto assets. So it will be taxable if the disposable, or if it is for the intention to dispose the original crypto assets. So additionally, a fork could be said to be a normal and anticipated consequence of holding crypto assets. So for disposals of airdropped crypto assets, in cases where the person had done something to become entitled to receive or to take possession of the airdrop crypto, so to done something to receive those gifts, promotional gifts, I can call it. The person may have signed up online to receive some of that. It will be taxable if the person acquires it for the purpose of disposal. If no positive action was taken by the recipient, then arguably the acquisition is passive, and it will not apply to the disposal of assets. I know it's quite complex, but I think it's the intention of the person that's receiving and dealing in it. So passive income or a passive as a gift, if you receive it as a gift, will not be taxable. But if it is part of remuneration or business income, it will be taxable. I hope that this was clarifying some of the questions you might have had. And don't hesitate to get in touch with me if you require more information. I'll gladly discuss this with you. Please subscribe to our YouTube channel, and by clicking the subscribe button, or and please click the like button. And looking forward to provide you with further information at a later stage. Thanks. Signing off.